Hi, I'm John Davis. I'm a CFF financial planner and I specialize in retirement and estate planning. Now, if you're watching this, it's because you love your family and want to make your retirement the best that it can be. Now, over the past 30 years, I've seen both really successful and happy retirements and really poor retirements. And since I've seen both, and with your success in mind, I put together a list of the top 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today. So let's get started. Number 1 on the top 7 list is not knowing exactly how much income you and your spouse can expect and count on from Social Security. So the first thing I want you to do is to go to the Social Security website. It's www.ssa.gov/my account. Follow their instructions and create a personal account for both you and your spouse. Next, download a copy of your estimate of your benefits. Again, get a copy for both you and your spouse. Why? Well, remember that while you might be retiring, your bills are not. You'll need to know how much your Social Security income will be after your paycheck stops. Secondly, let me ask you a question. Let me ask you a really crazy question. Do you hate your spouse? Crazy as that sounds, in a minute you'll understand why I'm asking. You see, the reason I'm asking is because what most people in a marriage don't realize is that if either person in the marriage dies before the other, the lower paying Social Security check is automatically taken away by Social Security. The survivor is left with one check instead of two. Let me give you an example. So let's say his benefit totals $36,000 per year. And let's say hers totals $18,000 per year. As you can see, one higher, one lower. But together, the two benefits total $54,000 per year, which is not a bad retirement income. Now, if either one dies, and it makes no difference which one, Social Security will automatically take away that lower paying $18,000 check. So instead of $54,000 coming in, your spouse just lost $18,000 worth of income. Imagine your boss calling you today and saying, hey, guess what I'm going to do for you? I'm going to cut your income by $18,000 a year. You'd say, hey, wait a second, that's a really big pay cut. Well, your survivor just took that kind of pay cut. He or she just lost a third of their income and is left with only one check for $36,000. Now, if you're thinking that's lousy, I absolutely agree. But here's the thing, it actually gets worse. While one spouse is mourning the death of the other, the survivor may or may not be able to afford their lifestyle. They might not be able to afford the things that they've been doing and been enjoying, a lifestyle that they've come to love. And number two, the survivor is now forced to pay more in taxes. No one ever talks about that. You see, the survivor is no longer a married person. They're now single, and they can't file a joint tax return. Now, as a single, you know that you wind up paying more in taxes. So here's what we know. We know that women generally outlive men. And we also know that most people don't hate their spouse. My guess is that you'll want to have a plan in place to replace that lost Social Security income. Now, you can build a plan to solve this on your own, or you can contact me using the information on the screen. I can help you put together a plan to replace the lost Social Security income and solve this problem. Another thing I want you to do is go to my website. The information is there on your screen, AmericaUnitedWealthPlanning.com. There you'll find my video, 10 Myths About Social Security. This is an educational video where I provide you with all kinds of information that's pertinent to Social Security. Information about your age options for applying, the advantages and disadvantages of taking benefits early or delaying, how to increase your benefits, if you can work and still claim benefits. So now you know about Social Security. Look at the 10 Myths Social Security video, and if you have any questions, give me a call. Remember, helping others is how we help ourselves, so I have no problem helping you with any of the questions that you might have. So number 2 on the list of 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today is not having powers of attorney or knowing if your POAs will work when needed. If COVID-19 has taught us anything, it taught us just how important it is to make sure that your legal documents have been reviewed and are in good order. Everyone should have a will or a trust. With COVID, that's a given. But have you reviewed your powers of attorney? Okay, so I'm not an attorney and I'm not giving legal advice. In fact, you can create your own legal documents. I'm sure there are all kinds of samples all over the internet that you can download. Or you can work with our attorney who can help you with this. What you'll need to know is that there are two types of powers of attorney. There's a financial power of attorney for finances and a medical power of attorney for medical decisions and treatments. Now, some of you might be asking, how do these things work? Well, I'm glad you asked. You see, a power of attorney, also known as a POA, allows you to legally appoint someone to act as your legal agent, but only if you're incapacitated and can't act for yourself. Let me give you an example. Let's say a person winds up in the hospital due to COVID. Well, first, imagine the fear and panic that their family experiences when they discover that their loved one is now quarantined and they can't physically meet with them. Then, to add insult to injury, let's say the family needs money. Let's say they need cash to pay the bills. We're talking about money for food, utilities, or property taxes. Well, what they're going to discover is that the financial institutions require that they legally present a financial POA in order to get money. You need a POA to get money from your loved one's qualified accounts. So now we're not talking about jointly held checking accounts or savings accounts. We're talking about qualified accounts where people have the bulk of their money. So I'm talking about 401ks, 403bs, IRAs, brokerage accounts, and insurance policies. Now, here's the thing. Here's where people make a mistake. They think if they're a spouse that they don't need a POA. But even if you're a spouse, you'll still need a POA. You see, as a spouse, you might be the beneficiary in the event of a death, but your loved one is still the owner, not you. Qualified accounts cannot be jointly owned. I mean, think about it. Remember that IRA stands for Individual Retirement Account, okay? So you'll still need a POA even if you're married. And finally, people quickly discover that the hospital requires a medical POA to make medical decisions and to authorize treatments. Without the medical POA, they won't treat your loved one. One more thing. Let's say you already have your POAs in place. Well, congratulations. And naturally you would think, well, I'm all set. I don't have anything to worry about, right? Well, let me ask you this. When was the last time that you had your POAs reviewed? Did you know that Social Security, Medicare, the IRS, along with the VA, require that special language be added to your POA? And without it, they're not acceptable. You see, most of the POAs that I review don't meet the requirements, which will render them useless when they're needed. Like I said, you can create the POAs on your own with the proper language. However, my advice is to work with a professional. I'll make sure that, number one, you have the correct POAs, and number two, that they'll be acceptable when they're needed. So now you know about POAs and their importance. If you have any questions, give me a call. As I always say, helping others is how we help ourselves. So I'm always ready to help you, okay? Number 3 on the list of 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today is not putting together a cash flow report to project your retirement income before you retire. Let me ask you this question. Are you 100% certain that you can afford to retire and stay retired? If you can't immediately answer this question, it's because you've not done a cash flow report. Understand that no one wants to create a burden or become a burden for their family. A cash flow report is a spreadsheet that eliminates this problem. A cash flow report gives you peace of mind. It breaks down all your retirement income year by year for your entire life. Only after you see everything all on one page that you could be 100% certain that you could afford to retire and stay retired. Now, to get started, the first thing you have to do is to open your checkbook and start totaling up your living expenses. What you have to know is, on an annual basis, how much it's going to cost you to live and support your lifestyle after you retire. Next, you have to put together a list of all reliable retirement income sources, whether it be Social Security, pensions, IRAs, 401ks, 403bs, or other investments. What you'll want to know is, number one, what your income sources are, and number two, how much income each source will produce. Once you have that information, you can plug the numbers into a spreadsheet and start to build a cash flow report. You can do that using all of your numbers. Now, if you do it right, it will show you how much you'll have coming in and compare it to how much you'll have going out, year by year, line by line, for your entire life. As I said before, you see, it's not until you see all the numbers on one page that you could be 100% certain that you can afford to retire and stay retired. A cash flow report is absolutely mandatory for retirement success. Call me and I'll email you a form that you can use to organize your figures and then start to build your own report, or get back to me. If you get back to me with your information, we could build a cash flow report using your number on an Excel spreadsheet, or if you provide me with all your information, I can run the report for you, and we can review it together. There is no cost or obligation. I just want to make sure that you have enough income in retirement. So now you know about cash flow reports and planning for them. Number 4 on your list of 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today is retiring without a survivor or legacy plan. Have you put together a plan to protect your surviving spouse's income and family legacy? Will your spouse have enough income to maintain their present lifestyle, or will they be forced to go back to work? For example, you've already learned that the lower paying Social Security check will automatically be taken away. But in addition to replacing lost Social Security income, does your plan replace other income sources? Does your plan consider both your survivor's income and include a legacy for your family? You can crunch the numbers on your own and build your own survivor and legacy plan, or I can build one for you. Now, if I build a survivor and legacy plan, I take into consideration the total income from all assets, and if needed, I can often create additional income and also create a legacy for your family. Obviously, you'll want this done before it's too late. Now, I have a quick question for you about your pension. A lot of people don't realize this, but have you explored all of your pension options in detail? Did you know that if you choose the wrong pension option, that you could accidentally disinherit your family without knowing it? Did you know that if you die, that your spouse's pension income could be reduced or completely lost? Do you have a plan to solve these problems? Did you know that with some pensions, if both you and your spouse go on vacation and if the plane goes down and you don't make it, that your beneficiaries could wind up with $0? Yep, your entire pension balance could be kept by the company. The good news is that there are simple ways to avoid this problem. When I build a survivor and legacy plan, I look at how much income your spouse and family can expect, as well as how much of a legacy your family can expect. Now, you can do this yourself, or I can run a survivor and legacy report for you. Again, there is no cost or obligation. I just want to make sure that your family avoids future problems. So now you know about survivor and legacy plans and reports. Number 5 on your list of 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today is retiring without planning for your new tax responsibilities. You see, your present tax pattern while working is that your employer takes care of your IRS tax reporting requirements. At the end of the year, your employer reports your income and sends you a W-2. You take the W-2 to a tax preparer who files your return for you. Now, after you retire, the stories change. Your employer will no longer be responsible for your W-2s or income reporting. Once you retire, you become responsible for how you declare income. The tax liabilities are now your responsibility. Now, if you get this wrong, you could face as much as a 50% tax penalty. Or worse, get it wrong, and you can run out of money in retirement. Now, in retirement, you have to know both what your taxable investments are and what the tax requirements are. So here's an example of what I'm talking about. Let's say you have a traditional 401k or 403b, and you retired and you left it with the company. Now, at age 72, under IRS rules, you're required to declare income from all traditional IRAs, 401ks, and 403bs. The income distributions are called RMDs, which stands for Required Minimum Distributions. What the government's doing is they don't want the money just to sit in your 401k. They want you to claim it as income so that they can tax you. That's all. That's the whole reason behind it. But the problem here is that if the stock market is losing money when your RMD is due, and you sell stock in this falling market to declare the RMD income, you lose even more money. Why? Because you're selling stock in a falling market to declare income. The stock values are falling and you're selling. So what do? Do you go ahead and take the RMDs from your 401k or 403b and sustain the losses? Or do you declare the RMD income from IRAs? IRAs that happen to be in profitable accounts. Well, guess what? Under current IRS rules, you're not allowed to take the income from those profitable IRAs. You must declare the income even if your 401k or 403 is losing money. You have to take it out of the 401k or 403b. So what can you do? Well, one thing you can do is roll part of your 401k or 403b out of the market and into market protected IRAs. You can do this even if you're still working, even before quitting your job. Now, most people know that they can do this under a little known IRS rule. And the great thing is that you can start with a simple conversation and we can help you with this. It's not that difficult to do, but you have to know about the rules and you have to talk to somebody who knows how to do it. So that's what I'm offering my help for. Like I always say, helping others is how we help ourselves. So if you have questions, give me a call. Let's talk about it. So now you know about your new tax pattern and some steps you can take to plan for it. So let's look at number 6. Okay. Number 6 on your list of 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today is retiring with no budget for non-insured medical expenses. Now, sad to say, Medicare doesn't cover all health services. A recent Fidelity study revealed that couples retiring today will spend around $300,000 for out-of-pocket medical expenses. Yes, again, we're talking about medical expenses not covered by Medicare. For example, the original Medicare won't cover your routine vision care or the cost of hearing aids or dental work or visits to the dentist. See, while you can't fight biology, you can actually plan for it. If these types of problems run in your family or you're already experiencing them, starting today, you can start researching dental and vision insurance plans. And you do this with the goal to find out how much you can expect to pay for these services. Next, just take the costs and put together a list of the dollar amounts. Total the expenses that Medicare won't cover and build these expenses into your retirement budget and cash flow report. Another option is to skip the original Medicare supplement plan and shop for a Medicare Advantage plan, one that includes dental, vision, and hearing coverage. These are things you can do on your own starting today. However, if you have questions or want a second opinion, give me a call. Let's talk about it. As I tell my clients, helping others is how we help ourselves, and great things always start with a simple conversation. So now you know about non-insured medical expenses and what you can do about them. Number 7 on our list of 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today is not determining where you're going to live before you retire. Some folks don't plan to move after they retire, and that's because they're happy where they are. Others want a change of scenery. They want to move closer to their family, to their children. But Retirement isn't only about where you live, it's about how you live. As our bodies age and we get older, we often require more help. So being located closer to help can be critical. It's really important to consider your age and proximity to health services. It's very important that you have a way to get to and from your health services, whether that be public transit, rideshare, or help from relatives. Now, if you're considering help from relatives, that's great, but you may want to consider moving closer to where they live and let them know that that's the reason why you're doing it. You see, they have their own lives, and driving 2 hours to provide help for you is a lot to ask of anyone. Now, another factor to consider is your neighborhood. If it's known for street crime or getting sketchier by the day, you may want to relocate. Whatever you decide, you'll want to do a little research before you decide to buy or relocate. So now you know about the importance of deciding where you live in retirement. That covers the 7 money mistakes guaranteed to wreck your retirement unless you start fixing them today. And as I tell my clients, you retire only once in your lifetime. As a retirement planner, I retire every day. You should start working on these today. If you have questions or you want a second opinion, give me a call. Let's talk about your future. Great things start with a simple conversation, and helping others is how we help ourselves. I'm John Davis, and I look forward to speaking with you.